As of 3 weeks ago, Starbucks is under new management. In mid-August, the Seattle-based coffee chain gave former CEO Laxman Narasimhan the boot after a sustained period of mismanagement and decided to bring in Brian Niccol, the mastermind of the turnaround at Chipotle. He formally took charge 3 weeks ago. Now, regular viewers know I'm a huge fan of this man. He's a turnaround artist. It's exactly what Starbucks needs right now. And Wall Street clearly agrees as the stock surged from $77 to $97 and change since his appointment, with the vast bulk of those gains coming pretty much immediately. But not everybody's on board with the new leadership. Last week, while we were out, 2 different sell-side analysts took the exact opposite view on Starbucks. Last Tuesday, a team of analysts at Jefferies, led by the appropriately named Andy Barish, downgraded the stock from hold to underperform, meaning sell, while slashing the price target down from $80 to $76. Good luck with that. Then just 2 days later, a different team of analysts at Bernstein, led by Danilo Gargiulo, upgraded the stock from market perform to outperform, meaning hold to buy. They raised the price target from 92 to 115. Now, personally, I have to tell you, I absolutely love these about faces. I like to go put them against each other because they let you pit the best arguments of the bulls and the bears against each other, allowing you to make better informed decisions about the stock in question, and also, of course, make you a much better stock picker. Let's start with the bear case from Jefferies. In their note, cleverly titled, "Will take some time to brew a fresh pot." The Jefferies analyst argues that despite all the enthusiasm for Brian Niccol, the fact is that turnarounds take time and they're also expensive. So any efforts to improve the business will hurt the company's near-term earnings power. Okay. They say they saw the stock had gained $25 billion in market cap since we learned Niccol was coming in, and they think that's, quote, too much too soon, end quote. Okay. Basically, Jefferies recognizes Starbucks has very real problems, and you can't just fix the stuff and restore the brand overnight. And you certainly can't fix them for free. In the end, Jefferies argues that the earnings estimates for Starbucks need to come down. More importantly, they expect management will give low-ball guidance for their 2025 fiscal year when the company reports in early November. That's why they cut their earnings estimates from 2025 and 2026 to levels that are well below the Wall Street consensus. That is important. And that's how they end up with the $76 price target. If they're right, then all the gains since Niccol's appointment would be wrong. Sobering. Hey, how about the bull case from Starbucks from Bernstein? Well, again, this is basically the exact opposite of the Jefferies call. In a note titled, Grande Comeback Upgrade to Outperform, they argue that the current valuation does not fully appreciate the earnings power that Starbucks could unlock. Then they go on to say they acknowledge the turnaround will take time. But crucially, they tell us, quote, "We believe that it will not need to be completed for the stock to start to work," end quote. That's right. The stock market is all about expectations. If you wait until the turnaround is fully executed, you're going to miss out on most of the gains. The whole show here is predicated upon that concept. The Bernstein team said that the appointment of Niccol as CEO and chair will free up management to draft a plan aimed at operational stability versus chasing growth at all costs, end quote. They said that they expect additional management changes and, quote, the reduction of spans and layers in the organization to act as a catalyst for the stock amid lower general and administrative expenses and streamlined decision-making, end quote. Sounds good to me. The Bernstein analyst went on to argue that, quote, the operational focus of a more streamlined Starbucks will have several tangible benefits, like one, the stabilization of store operations, faster throughput enhancement in brand and value perception, that is, improved store ambience, transparent pricing. And purposeful innovation should result in positive traffic growth. Yes. They can see that less customization brings might pressure same-store sales, but said that the benefits from all these other factors should lead to, and I'm going to quote here, a reacceleration of traffic-driven comparable sales growth, end quote, which is exactly what you want if you're a shareholder. Finally, Bernstein argues that, quote, despite investments in labor, equipment, and technology, we expect the operating margins to improve to historical highs by 2028, given the sales leverage and operational efficiency unlocked by the investments, end quote. Basically, Bernstein's agreeing with the Jefferies analysts that investments are coming, but they're less focused on the hit to earnings in the next year or two, more focused on the potential earnings gains in 2027 and 2028. Now, even the bulls at Bernstein believe the estimates for 2025 do need to come down. In fact, Bernstein's expecting lower numbers than the bears at Jefferies for the next 12 months. However, from fiscal 2026 and fiscal 2028, they're projecting a tremendous 20% compound annual growth rate for earnings. That'd be amazing. The price targets based on 2026 estimates, that's how they see the stock going to 115. So where do I come down? Look, we've got a substantial position in Starbucks for the Charitable Trust, and we haven't sold a share since the news that Brian Niccol was taking over. So clearly I am siding with the bulls on this one. Again, I don't expect a strong fourth quarter. The new guy only started 3 weeks ago. I don't expect particularly good earnings in the 2025 fiscal year either, although I'm not sure whether that means flattish earnings growth or maybe a genuine down year. In the end, though, like the bulls at Bernstein, I'm willing to look through a weak year if it means Starbucks can come out the other side much stronger, and I believe Brian Niccol can pull that off. Doesn't mean the stock won't sell off if management lowers expectations, something that I do expect. It just means I'd recommend buying more Starbucks into weakness. In the end, I have more faith in Niccol's ability to get Starbucks back on track than the bearish Jefferies analysts. If you look back on his past 6 years at Chipotle, some of the best things that he's done have been on the operational front, creating robust digital ordering infrastructure, configuring stores with things like second preparation lines and drive-thrus to make sure they're churning through all their additional orders without creating long lines and a negative in-store experience. He is basically a throughput expert. And throughput is, frankly, the biggest problem for Starbucks right now. Plus, don't forget about all the positive news out of China this week. This is the second largest market for Starbucks, and it's been a total dog. But now the Chinese Communist Party has finally started aiming some stimulus directly at consumers, which should translate into a stronger economy and better business for companies like Starbucks with big China exposure that have lost share to cheaper alternatives. And that would be a huge positive. So here's the bottom line. When you really drill down, the bulls and the bears on Starbucks don't seem to disagree so much on the facts. Everybody acknowledges the near-term numbers will be distinctly suboptimal. It's more about emphasis. The bulls are willing to look past short-term pain because they believe in Brian Niccol's ability to turn this thing around. But the bears don't want to take that kind of risk. As for me, I am a bull on Starbucks with this new CEO. I think he's got such a great track record that he's more than earned the benefit of the doubt. Niccol's worth every nickel they're paying him. All right, let's go to Frank in Michigan, please. Frank.
Hey, Mr. Kramer. It's a pleasure to talk with you.
Right back at you.
We're calling from a town that, is turned around. We got the Tigers in the playoffs. We got the Lions playing tonight in the Monday Night Football. And I'm trying to see an analogy here. I like a stock that I've had since $28 called BJ's Wholesale. Could this thing be a champion one day like a Costco? Is this possibly a baby Costco?
Okay, this is a really tough call. I mean, I like BJ's. We go to BJ's. But we're a Costco people. Like many people, this thing sells at 21 times earnings, so it's a little bit cheaper than Costco. But I think it deserves to be cheaper. Costco's the better one. But I do want to congratulate you guys in Detroit. I got Sam Laporta going tonight, and it may not matter that much. But, boy, I sure do like your team. And go Tigers. They're pretty great. Let's go to Rodney in Texas. Rodney.
Booyah, Jim.
Booyah.
How are you today?
I don't know. Back from vacation. The Eagles lost. I'm trying to regroup, frankly.
I understand.
Mets won, which I don't really care about, but my producer sure does.
I got you.
I wish I didn't care so much about sports, Rodney, and more about making big money for people. But right now, I'm possessed by how bad the Eagles are. Let's go to work.
All right. Yes, sir. So here's my question for you. So with the recent rate cuts that we've had here and the Fed's coming out with what their plan is for the next to the end of the year for the rate cuts coming up. So my stock is Airbnb. My average price is $143.
Okay.
What do you think is going to happen with all these rate cuts? What's going to happen with Airbnb?
I think I'm so glad you put it this way, because I think that Airbnb is one of those companies that will actually do better when rates come down and people start doing more traveling. But most importantly, this thing is run by Brian Chesky. He has always been very conservative. And then when the numbers come out, I feel pretty darn good about it. I suggest that you actually buy a little more. It's down 7% for the year, and I like it. All right. The bulls and bears on Starbucks both seem to realize that the company's near-term numbers will be suboptimal. But I'm siding with the bulls on this one because the new CEO has just such a great track record. Much more mad ahead, including my exclusive with H.B. Fuller. The Fed's starting to cut, and China launching a stimulus push abroad. Could an economically sensitive company like H.B. Fuller be worth looking at here? I'm sitting down with the CEO, and the decline in the price of oil is pretty remarkable. I'm using history as my guide to make sense of the latest action. Of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Kramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Kramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.